Thanks, Melissa. A new report just out this hour on Wall Street bonuses, and it shows that there are soon going to be some clear-cut winners and some clear-cut losers. Leslie Picker joins us right now. She has all the details. Hi, Leslie.
Hey, good morning, Becky. Most Wall Street employees will see their bonuses decline this year, but there are a few exceptions. That's according to projections in a new report by Johnson Associates, which does compensation consulting. The biggest slump in bonuses is expected in retail and commercial banking, with bonuses down as much as 30% from 2019 levels. That's due to substantial credit loss provisions for defaults that are projected to arise from the pandemic-led shutdown. Defaults of portfolio companies could also dent bonuses in private equity by about 15%. Even though the markets have recovered, hedge funds and asset management firms are expected to slash bonuses by as much as 15%. The picture for investment bankers is a bit more mixed, with those advising on M&A expected to see an incentive comp fall by as much as 15%. Those doing underwriting, however, both in equity and debt, could see bonuses jump by 20%. And the real bright spot? It's sales and trading. Johnson Associates expects those bonuses to jump as much as 30%. And guys, even though larger firms pledged not to lay anyone off this year, Johnson Associates says layoffs in the industry, potentially the smaller firms, will accelerate in the second half of 2020. Back over to you.
Leslie, I think it's going to be fascinating this as we get into sort of January, February next year. We start to see bonuses across all sectors, not just the banks. And I think it'll be a big job for those of us in the business news to hold to account any CEO that even gives a $1 bonus if they have had significant layoffs in the past year. But to your point, towards the end of that script there, it's interesting with a lot of the big banks, they have pledged no layoffs this year, and some of those, the investment banks of this world, will have very strong years. They've had very strong first couple of quarters of the year. If that continues, therefore, it's hard to argue against large bonuses if those two criteria are met. Strong years, no layoffs. Certainly, you would say once you go a level or two below the top management, where it's then not publicly disclosed. But even when those two criteria are met, I mean, just think a James Gorman, a David Solomon, a Jamie Dimon, if they're paying the top-level employee a massive bonus, it's going to be politically unpalatable. But certainly the level or two below that, if they've had strong years and they haven't had any layoffs, you can't really argue with a big bonus.
Right. I think what's really interesting about 2020 is that you do see this benefit for employees who work at the bigger firms. You know, the ones who work at Morgan Stanley, Bank of America, Citigroup, for example, work at companies that have pledged no layoffs. And, you know, they, according to this report, could see better bonuses. Those who work at kind of the second-tier private equity firms, hedge funds, just overall commercial banks could take a larger hit with their bonuses. And I think that speaks to just these economies of scale that the bigger Wall Street firms have been able to benefit from in 2020 in particular.